Have you been wanting to purchase a home, but the spike in interest rates that we've seen this year has made it unaffordable to you? Well, in today's episode, we're gonna go over the top 5 ways that you can get the best interest rate possible on your new mortgage so you can afford to move into that new house. Hi, I'm Josh Alexander and your host of Orange County Housing Market News, your one-stop shop for all things Orange County real estate. So in today's episode, like I said, we're gonna be going over the top 5 ways, and most of them are free, to be able to get you the lowest mortgage interest rate possible so you can afford getting into that new home. So let's go ahead and get into it. Interest rates are currently at 20-year highs right now. And on top of that, we have seen a giant skyrocketing of housing prices over the last couple of years, which makes those monthly mortgage payments extremely hard for a lot of buyers right now to afford. So in today's episode, we're gonna be going over those top 5 things that you can do to make sure you're getting the best interest rate possible on your home. So number 1 is going to be check your credit score. Now this might seem obvious, however, one of the biggest mistakes that a lot of buyers are making is they don't really monitor their credit score until they're a few weeks out before they start applying for loans. And at that point, if your credit score is not where it needs to be, it's going to be very hard for you to fix it in that short of a time frame. So my recommendation is, before you decide to purchase a house, at least a few months in advance, I recommend 6 months in advance, start monitoring that credit score. If that credit score is not where you want it to be, so most lenders require a score of around 740 to 760 or above to get the best rates possible. And if you're just trying to improve your score as much as you can, and you know you're not going to be able to get it that high, you still have enough runway to be able to do that. You can start paying down your debts and seeing that score start to go up. And if you don't know where to start, this is a great opportunity for you to reach out way ahead of time, talk to a lender, talk to a real estate agent, and they can recommend a credit repair service that's going to help guide you through the process to get your score up to the highest point that you can get it within that given time frame. So again, you want to make sure you're monitoring this way ahead of time, ideally months in advance, so that way you can take care of any issues that pop up, so you get the best interest rate when you decide to apply for a loan. So the second thing you can do to improve the interest rate you're getting on your loan is make sure that you're talking to multiple lenders when you decide to go through that pre-approval process. Every lender is going to be a little bit different in terms of the rate they give you, the programs they offer, as well as the fees that you need to pay in order to be able to get those low interest rates. So make sure you're doing your due diligence and speaking to multiple lenders. If you have a credit union you work with, typically credit unions are going to give you great rates. If you're talking to a mortgage broker, they're going to be able to shop around and find the best program for you to give you the lowest rate possible. So I typically recommend that you talk to 3 different lenders when you're going through this process to know that not only are you getting the best rate possible, but you're finding a lender that you're going to work well with and that's going to have the best program based on your specific financial needs. Now, real quickly, one question that I get often about talking to multiple lenders to find the best rate possible is, how much is that going to impact my credit score? Well, the credit score will be impacted when the first lender does a hard inquiry on your credit to be able to see if you can qualify for the loan. However, right now in the United States, as long as you talk to other lenders within a 45-day period, your credit score shouldn't drop anymore after the initial credit hit when the first lender looks at it. So you can talk to 2, 3, 4, 5 different lenders, and your credit score is only going to go down when that first lender actually goes and runs your credit. So feel free to go out and look at multiple lenders to find the best rate possible, and know that it's not going to dramatically impact your credit score. So you first got your credit score as high as it could be before you applied for loans. You went and applied to multiple lenders for those loans to find the best rate possible. Now comes number 3, and this is when you actually start placing offers, and this is where the seller can actually help you get a lower interest rate than the lender is even offering. So the first way they can do this is what is called a 2-to-1 buy down. So what this basically does is it drops your interest rate a significant amount for the first year. It goes up slightly more the year after that, and then the third year it goes to the normal rate. Now this is something that you can actually ask the seller to pay for, so it's no money out of your pocket and could make sense in some circumstances. Now something that might pop into your head when you hear about this is, wait a second, this sounds like one of those ARM products that got a lot of homeowners in trouble back in 2007, 2008, and 2009. So this is something that, number 1, you need to make sure that you can comfortably afford the highest interest rate, which is that year 3 interest rate, and are not going to have any issues with that. Are you going to have an opportunity to maybe refinance and get a lower rate within the first 2 years? It's a possibility, but you can't bet on that. You need to make sure that you can afford that higher rate. And you also have to understand that this buy down is something that you're asking the seller to pay for. So it's not coming out of your pocket. It's basically just a free lower interest rate for the first 2 years, and then it goes up to the normal rate after that. And because in today's market, we are no longer in this hot seller's market, sellers are starting to make concessions and giving credits for buyers to do these type of things to help out with those monthly payments. Now, obviously, again, this is not going to be for everyone, but it's a product out there that could help you temporarily lower that interest rate for the first year or two. And again, hopefully you might be able to refinance, but you need to make sure that you can afford that higher rate. And this leads me to the fourth way you can get a better interest rate, and it also has to do with a buy down program, but this is going to be for the life of the loan. So again, you're going to be negotiating with the seller, asking them to credit you to purchase a lower rate for your interest rate, except this time it's going to be for the life of your loan. So you're not going to get as big of an interest rate discount like you would on those 2-to-1 buy downs, where typically you might be getting a normal 6.5% interest rate, but the first year you're only paying 4.5%, then it goes to 5.5% before it goes to the full rate of 6.5%. On these long-term buy down programs, you might be getting 0.5% or maybe 0.75% difference on those payments. However, this is again for the life of the loan, and typically in this market, it's a good idea to try to get the seller to pay for that. Now, if the seller doesn't want to pay for it and you still want to buy down that rate and you have the cash to do so, as long as you're going to be in the home long term, typically this type of buy down program will end up paying for itself. Now, to best determine if this program is going to be right for you, the best thing to do is really discuss it with your lender. They're going to be able to show you a graph and a table saying, if you spend this amount of money and get a lower interest rate by this percent, it's going to take this amount of months for you to break even, and after that you end up making money. So a lot of it's going to have to do with how long you plan on being in the property. And again, you can talk to your lender because they're going to be able to give you the breakdown of when that break-even point is, so you know if it's something that's going to work for you and your family. So now let's go ahead and go over the fifth and final way that you can get a lower interest rate when going to purchase a house, and that's called assuming the seller's loan. So what this basically does is that if the seller has a VA or an FHA loan, a lot of lenders will allow the buyer to assume that loan. And what that means is, let's say they have a property that you're paying $800,000 for, the seller still owes $700,000, you would need to bring to the table the difference of that $800,000 to $700,000, which is $100,000. But by doing so, you're going to be able to take over that loan at whatever interest rate the seller had. So if the seller either bought their home or refinanced over the last 2 years and has an interest rate at 2.5% or 3%, you're going to be able to capture that interest rate and keep the interest rate for the life of the loan. So that's going to be the absolute best way to get the absolute lowest interest rate possible. However, this is not going to work in a lot of circumstances because, one, you have to have the down payment for it, and typically you're going to need a sizable down payment to cover the difference between the purchase price and whatever the seller has left on the loan. But if you do have that down payment, this is a great option for those sellers, again, that are using an FHA loan or a VA loan on the property. So you need to make sure that you're talking to your agent, making sure that you ask the seller what type of loan do they have, how much do they have left to pay off, to see if it could be a possible option for you. Yes, it might take longer for you to find that ideal situation that's going to work out with you based on your down payment and how much the house is, but if you're able to find that, it's going to be a gold mine in terms of the interest rate you're going to get, so it could be worth the wait and is definitely worth exploring with your agent. So if you are thinking of looking for a home in the near future, but you've been discouraged about those interest rates, these are some strategies that you can use to be able to knock down those interest rates and make the homes affordable for you again. And I would definitely encourage you to look into these before you completely give up, because right now, based on the current market trends, we're heading closer and closer to a buyer's market where sellers are making a lot more concessions, paying for a lot of these buy down products, as well as you're able to secure property below asking price. Right now in Orange County, almost 50% of homes have had to do price drops. So there's a lot of negotiating power that buyers have right now. So if you're able to afford the monthly payments, or you're very close to it right now and you're just kind of on the edge, these are some programs you can use to get you over that hump into a house right now, and you're able to negotiate a great offer because of the current market conditions. Now, if you're watching this and you purchased a home recently by using one of these strategies, please comment below, share your story. I'd love to be able to see examples of how buyers are using these strategies to get into homes right now with a lower interest rate, as well as take advantage of the current market conditions to be able to negotiate in their favor. So as always, if you have any other questions, I'm here to help. Please DM me, comment below. I'll answer any questions. And until next week, stay healthy, stay happy, and I'll see you on the next show. Bye.